Good morning. Welcome to Brownfield's Quarterly Market Outlook. I'm anchor reporter Megan Grebner. With us this morning is a full slate of fantastic economists, and we're going to have a great discussion talking a little bit about cattle on feed, hogs and pigs, a little recap of 2020, and the best part, a look ahead to 2021, which is just around the corner. With us is Seth Meyer, who's currently still with the University of Missouri's FAPRI, Josh Maples with Mississippi State, and Scott Brown with the University of Missouri as well. Good morning, gentlemen.
Good morning, Megan.
Good morning.
All right, let's get right into it. And Josh, I'm going to start with you. Cattle on feed recently came out. As we take a look at those numbers, talk to me a little bit about some of the high points and low points and things that cattle producers need to be paying attention to.
Yeah, well, thanks, Megan. Good morning, and appreciate the chance to join this discussion. So we're talking about the December cattle on feed report. It came out just about 10 days ago or so. Overall, Megan, this report really didn't have any big surprises compared to what the pre-report expectations were. Going into this report, we were looking for expecting lower placements and marketings compared to the previous year. And the actual numbers came in really close to that. So placements down 9%, which is a big drop. But again, it was pretty well anticipated going into the report. I think one of the things that sticks out to me on this particular report is, December is usually our kind of high water mark in terms of feedlot inventories. And that's going to be the case for 2020 as well. But it's pretty amazing, Megan, if you were to just look at this report compared to December 2019 report, inventory is within like 5,000 head. And obviously that conceals a very, very turbulent 12 months in between there. We've seen some really wild placement swings, when we were up more than 20% back in the spring. We had some really low points, we're down 20+% in the spring, on placements. And up as much as 11% back during the summer months. So I think that's the thing that sticks out to me is, you look at this report, compare it to where we were a year ago, and we're going into 2021 with a very similar feedlot inventory setup as we started 2020 with, even with all the volatility that we've seen throughout the year. So total on feed around 12 million head on December 1st. This was up just slightly from 2019. Those are the things that jump out to me. I'll be happy to dig in on some more if you want to.
I want to talk a little bit about weights in general. Scott and I talk weekly, and we talk hog weights on a regular basis. When we look at those cattle weights, we're seeing those moderate a little bit. Is that putting us in a better position, knowing where we are processing wise and then heading into 2021?
Yes, of course. And so if we look at the fed cattle weights, I just had those up earlier. You may have to help me out a little bit. I hadn't looked at them last week.
I think there was 13 pounds, right around there. It had dropped off significantly.
Yeah.
From where it was.
Yes. So, of course, weights have been a big deal throughout the year, especially with the backlog that we were dealing with. And seeing those weights come back down is certainly putting us in a better spot going into next year. I think we've mostly worked through a lot of the issues that were brought about back in April and May. And I think this report and really the last couple of reports have continued to kind of tell that story. And so we can continue to see those cattle weights come back down to more normal levels. We're entering 2021 in a much better spot than really a lot of us thought we would be just a few months ago.
When we look ahead, what are some things that, and we'll get into the outlook a little bit more, but I think that maybe we're also continuing to watch commodity prices and inputs. Is that one of the biggest cautionary or concerns that you have for producers looking ahead?
Absolutely. Yeah. So that's one thing that is very different from a year ago is, we're looking at a pretty good increase in feed prices. Grain prices have jumped pretty good bit compared to where we were, especially a year ago. And they're not high, but they're higher than they were. So we are going to see a kind of different feeding environment. We're in a different feeding environment now. So I think that's certainly one of the challenges to look forward to is what are feed costs going to do over the next couple of months, and how is that going to impact those decisions that are made in the feedlots?
Let's talk a little hogs and pigs. Scott, that report came out last week. As we take a look at those numbers, what are some of the biggest takeaways for that report?
Well, Megan, I certainly think we got a mixed bag out of the hogs and pigs report last week. Let's start with the most positive piece of news out of that report, and I think that's the 6.276 million head of sows on inventory as of December 1. That certainly came in, below pre-report estimates. 3% lower than a year ago. The average pre-report was at 98.2. It actually fell outside the low end range. So perhaps we've lost more sows as we look at the report we got. However, again, as I say, a mixed bag, and it's really hard to get a lot of direction here. Pig crop, if we look at that Sep through November pig crop, stronger by about 1 million head than many of us would have anticipated pre-report. A lot of revisions that we got in this report, and I will always say I didn't want to be in USDA's shoes and trying to handle hogs and pigs reports in the worst of COVID-19 with all the slowdown, shutdown on the processing side that we saw. But some pretty good decreases, especially if you look back at the June report, total hogs for marketing, a 2.27 million head reduction in revision that we got in this December report. However, they really didn't carry that through. By the time we look at September, now only 665,000 head lower than where the original September report was. So we got less hogs back in June, but not so much now. So I guess I look and I go, the other piece here, sows farrowing, especially intentions going forward. December through February intentions at 101.6. That's outside the upper end of the pre-report range. Kind of hard to compute those intentions relative to sow numbers. So we'll wait and see. But I want to make sure that we at least remind ourselves that fewer sows is a better thing. Getting supplies in better check than has happened in the last few years might be good in what's some demand uncertainty as we get into 2021.
When we talk about the demand uncertainty, obviously we look first to China, but I think also there's concern about domestic demand long term as well, because if there's a drop off in Chinese demand, that means we've got to carry more pork over, and the economy still isn't necessarily back where it was pre-COVID.
Yeah, for me, that's the big question. And in fact, for me, hogs and pigs gave us a little bit of help in terms of maybe less supplies of pork in 2021 than I would have thought pre-report, just given that decline in sow numbers. But the demand side is a big issue. And yeah, we might want to very quickly jump to China. And I go, that's just one piece of the puzzle. If China decides just to hold flat in terms of trade with us in 2021, that's one thing. But if they say we don't even need any pork from the United States in 2021, that's far another that could be really devastating. That second scenario takes some pretty gosh darn strong domestic demand to hold any kind of price level. And I sit here and I go, what's the economy really going to look like? Are we going to come out gangbusters as we hopefully begin to get enough of the population vaccinated to talk about a true reopening of restaurants, for example? I still think there's consumers that are going to be excited for the day. They feel like they can go out and have a really good meal. Now, what they consume at that meal might be open for debate as well, but more restaurant traffic, I think, generally could be beneficial. It's just how many dollars do they have in their pocket at the end of the day for what might be that pent up demand for eating out again.
Seth, I want to bring you into this part of the conversation as well. We talk about the overall look of the ag economy, and my perception this year has been it's a little bit of a roller coaster, at least when I look at the livestock side of things. But on the grain side of things as well, which is an important component to the bottom line for our cattle and hog producers, how does that continue? How does that look from 2020? And what does that mean for us moving forward?
Well, so I think 2020 has been when you look at the bottom line for farm income, it isn't a record, but it's going to be quite a good year for farm income. Now, when you look at that, it's also on the back of record large direct payments from the government. And so while I think producers are happy that farm income is high, I think there's also a bit of trepidation because although they spend the same, $1 from the market and $1 from the government don't always feel the same perhaps to producers. So I think they became a little bit more optimistic as we saw grain and oilseed prices rise, saying, hey, I'm getting more of my money from the market. But when you look forward, we just got another chunk of money passed to the ag sector. So it's hard to tell, we're going to come off a really great year for farm income into something that may just be good, pretty good if some of that money flows back to producers. This program's a lot more prescriptive in terms of who gets what. So it's less the secretary making some decisions on where the money goes and a little bit more about what came out of Congress. I think from the other part of the ag sector, so we do have, we were talking, Scott's point about China holds for grains and oilseeds as well too. Is that demand which is transient, or is that demand going to continue? Are they building stocks and they'll get there and that demand slips? And then further on to what Scott was saying, I think what is really interesting that surprised me and surprised a lot of other people this past year is disposable income's actually up for 2020. Disposable income's actually up. So when you go into 2021, the economy comes roaring back. Does disposable income shrink, or do we have more government stimulus, which continues to put money in folks' pocket? And so how does domestic demand on the meat side work? I think that these guys would have a lot more to say about it, but that's also interesting to me as well too. So I think everything that Scott has mentioned, you can extend into the grains and oil seeds and into Chinese demand.
How does that play? How does Chinese demand for grains and oil seeds as well play into the economic picture for the livestock side? Because I would assume more demand for corn, soybean, meal, etc., is going to put some pressure on our cattle and hog guys in the long run as well.
Oh, no, absolutely. Basically, since mid-August, we have seen corn and bean prices going straight up, just on a path of gaining prices. And they go up, and they're going to put a pinch on the margins for the livestock producers. And these guys talk a lot more about that. But, that's Chinese demand it's a smaller U.S. crop, and it's Chinese demand and some smaller crops elsewhere around the world. But, even if you say 50-50 split, that Chinese demand is contributing a chunk to those rise in prices. Now, we saw a little bit of gains in the last couple weeks with Argentina having their shutdown in crushing and transport, but that appears to have been solved. And so the market will have to evaluate that as well too. And soybean harvest in Brazil has just begun. So we'll see how that crop really looks at the end of the day. They had some weather issues, and they'll turn right around and put corn in behind it. So anyway, that was a lot. I covered a lot of ground, I know.
Perfectly fine. So let's talk trade. I mean, I think that's, as we look at 2020 in general, pretty solid news on the trade front on all aspects. Is there one portion of the ag economy that's benefited more, or has it been a pretty solid year for everybody when we look at that trade picture?
I think I'll let the livestock guys talk about meat first of all, although it's not as much of the total as some other commodities. For those folks, it's important.
You can start on the hog side of that equation, I think, Megan, and another 1 billion pounds of pork left the United States in 2020. That's well above any kind of long-term growth that we've seen in pork exports. Had we not had that, I would worry about where prices would have been. So I do think that the demand side's export demand side has been, critical on the pork side. I guess as I, start to look ahead, I'm a little more concerned about continued growth in pork at the rate we saw in 2020. But I can get much more excited about the cattle side of the equation. And I guess, as we were talking about feed costs, all of this just reminded me there are opportunities for folks to do risk management on all sides of this equation. I think that weather's had an impact on feed cost as well as export demand, as Seth alluded to. I think we might have lulled ourselves into this kind of sense of flatness or not, a little less volatility, especially for livestock producers from a feed cost perspective. Those days might be gone now. And so let's make sure that we're doing all we can to reduce some of the risk that we likely face, going forward.
Josh, oh.
No, I was going to say, before you go on to cattle, so the benefits or the concern about Chinese demand for the pork guys, the other side of that is the soybean guys doing really, really well. There are lots of questions about how this growth out of ASF in China has occurred. And because pork demand is what's going to drive that meal demand higher and soybean demand higher. And so are they coming out of it fast? So the other side of that is if they decide they need less pork, maybe it's they need more beans. And again, I think we've gone back to, I've been surprised probably 11 out of the 12 past years about how strong Chinese soybean demand has been. And that 12th year was ASF, right? And which was the kind of the downside surprise. So, you've got what appears to be strong demand. China also, for the first time in my memory, blew through its TRQ for the year for corn. And again, let's go back. Is this transient demand or have we turned a corner on some of these things? Are we going to get back on a pace where we see, even if it's not the pace that we saw in terms of consumption year over year for meal, those are still big numbers for feeding of soybeans. And what does corn look like? Have we turned the corner and that's going to be something they start to take more regularly? Sorry, Josh, I hope I didn't derail on that one.
No, you didn't, Seth.
Scott said he can be excited about the trade picture a little bit more than cattle, which is how we were going to transition into Josh. So when you look at the trade picture, again, China continues to be part of that. While it's not big, there's a whole lot of opportunity for that to continue to develop as well.
Absolutely, Megan. And you're right. It's not big, but it's certainly getting bigger. We're seeing some real growth there. And that continues to be a big story and a number that I look at every month whenever the new numbers come out. But I'm with Scott. There is some reason to be optimistic on the beef side. The middle of the year for beef exports got flipped upside down. Obviously we had the record high beef prices, and that really was that really impacted beef exports. So we saw some low numbers during the middle of the year, but it's roared back, and we're starting to see. I think in October we actually saw beef exports above year-ago levels. So I think you're right, Scott, and I think looking at what continues to happen with the pork side, obviously has impacts on what happens on beef as well. So I'm looking forward to 2021 and I'm optimistic about beef exports as we go into next year.
And for those who are watching us on Facebook Live as well, feel free to submit questions. We'll throw them at our experts and let them swing for the fences with those. So when we talk about outlook for corn, soybeans, hogs, cattle, I think we have to talk about risk management. And I know, Scott, you brought this up a little bit. Josh, I'm going to start with you. When you talk to cattle producers, what are some things that you're emphasizing when it comes to risk management and looking to capitalize and also protect the bottom line long term?
Well, I'm very glad that Scott brought up the risk management on the input side as well, because that's a note that I was wanting to make sure that I brought up. Scott, I completely agree. If you look back at the last few years, I think the risk management on inputs for cattle producers is really not been as big of a focus. I mean, for obvious reasons, right? Input prices have been relatively low. I think that's changing going into next year. And I mean, just based on the conversations that I'm having with producers, I think it's already changed due to the things that Seth has mentioned earlier. So that's a big one. Look at the inputs. What can you do to help manage your input cost and to not let that get out of hand for you? On the marketing side, for the cattle marketing side, Megan, I'm optimistic about prices in 2021, primarily because of the supply situation that we're looking at. We know the beef cow herd peaked probably last January. So we've got in 2019, so our 2 Januaries ago now. So we've had lower calf crops last year. We're expecting a lower calf crop this year. Fewer feeder cattle out there, fewer live cattle out there. So I am optimistic about prices, but that does not mean that we can't, or that we shouldn't still consider some price risk management strategies. And so that's one thing that I'm talking to a lot of producers about is, even if you are optimistic about what prices are going to do in 2021, which I think a lot of producers are, try to pick your spots to do some price risk management. Have that plan in place, at least a loose plan as we head into the first of the year, of knowing when you're going to market your calves or market your cattle, and having your options available to you. Because I think there's going to be some opportunities this year to use some risk management strategies to make sure folks are profitable.
Scott, what about the hog side of things?
So likewise, I think, we've summed it up well. I think that the China side of this is maybe more upside risk for feed costs and maybe more downside risk for hog prices. And it's both sides pulling the wrong direction for us, taking advantage of lower feed costs or maybe some higher hog prices to lock in some reasonable returns might be wise. And again, I always like to remind us that we're not doing risk management to hit a home run. We're doing risk management to hit a bunch of singles and doubles. So we're not going to swing for the fences, despite that's what you wanted us to do this morning, Megan. I always view risk management as that, hey, I want to reduce risk. I want to let someone else have the risk. It doesn't mean I hit the top of the market. But again, when you look at hogs in particular, you have both feed costs and hog prices that are moving in a way that might suggest lower returns. Let's find ways to offset some of that risk. And, we haven't really talked much about this, and maybe it's a little more cattle than hogs, but some of the new LRP requirements that USDA is providing these days make those opportunities easier for smaller producers than they've been in the past as well, with higher subsidies available on some of those LRP products. So I hope folks will look at that. And I say all the time, doing the same thing year after year after year is a risk management strategy. It may not be a good one. And so now may be a time, and I think Josh is right. There's reasons to be optimistic. So you may do risk management and find that cattle and hog prices have risen above whatever triggers you said, or feed costs went down. That does not mean that was a bad decision to employ some risk management. You want to avoid the worst outcomes, because one could tell the scenario of no export support to China. They want a bunch of corn and soybean meal, and domestic demand falters because we don't recover from COVID as fast as we want. Seth alluded to disposable income likely could be down in 2021. You kind of put all that together and you can tell a really negative story. And I think that's where a lot of us struggle with how to talk about recovery after what's been a pretty tough 2020.
You bring up African swine fever, and while we're talking hogs, cases in Europe aren't necessarily slowing or being eradicated at all. Do we still get nervous about biosecurity issues, and that being a potential for a market disruption in 2021 and beyond if we happen to see it break in our wild boar population here?
For sure. I mean, that scenario, I think, plays out not so well for us as well, because we if we break with ASF here in the U.S., it probably is in that wild population is where we're going to break, and that might turn some markets off for our exports. And so that's one of those that if it happens, it's not good. Um, and you need to protect against the risk of that happening, which, by the way, we don't know what's going to happen in China either when it comes to ASF. It's not like it's gone. Um, they're managing it better. And I think that's important for us to recognize that another ASF outbreak in China that accelerated could create positive opportunities for us. So it's a lot of uncertainty that we see, but let's hope we don't play the ASF scenario out here in the United States.
Seth, let's talk a little corn soybean outlook for 2021. As you look ahead, what are some of the things that you're watching and some things that producers maybe need to take note of?
Okay, so these guys mentioned when you're talking about risk management, you got to understand what the upside potential is and what the downside potential is. So again, we talked about under predicting Chinese demand. Well, one could tell the other story as well too, which is it's transient stock building in the face of what are uncertain times in COVID. And I will also say that for the moment, we've had a good year, not just because Chinese, I'm channeling Pat Westhoff at the University of Missouri here. So it's not just because China is doing well, but because other folks have kept in the market and we see things like a bad Ukrainian corn crop. All right. So for me, when you look forward, you have to understand a few things, and in your risk management, be aware of these, which is if we simply have normal prevent plant next year, we'll gain a couple million, 2-3 million acres of corn and soybeans, most likely. And that's just if we return to more normal prevent plant. Everybody forgets that this year was a big prevent plant year because the year before was so large. So, you got to understand the South Americans are getting a strong price signal for that second crop corn, even though it's late. This soybean crop hasn't been so great, and there's concern about rainfall shutting off. But we're going to gain several. We may very well have a total of corn and soybeans north of 181 million acres next year, right? And that's under a normal prevent plant. And folks are saying, yeah, it's dry. Well, dry probably only ensures you get more acres planted with these prices as well, too. And you end up with a big crop if that dryness doesn't come through the whole year. So I think understanding these risks, we've had a heck of a run. So you got to keep an eye on those things. And we could continue to, China could continue to have stronger demand, and the rest of the world could as well, too. But you ought to understand those risks. We may very well have big crops next year for both corn and beans. But things have gotten tighter. We've tightened down stocks tremendously. So that'll make that market more volatile.
Josh, when you look at the trade picture for cattle, where do you think is the best growth opportunity to send more U.S. beef? Is there a market maybe that we talk about China and the ability potential to see massive growth there, but when we there's our home run market, but our singles and our double markets when it comes there as well?
Well, I mean, I think China is the big one, Megan, as far as the one that's got the most upside growth potential. You've got our more normal markets, and especially South Korea has come on exceptionally strong the last couple of years. But as far as looking at where the potential for the big growth is, longer term is certainly China. I mean, I think that is the reason that we talk about it so much.
Scott, is there a market that you're looking to on the hog side of things?
So I think you have to just stay focused on China. And I want to remind us, even with current projections for 2021, consumption of pork in China will still be 10 million metric tons below where it was pre-ASF. If the Chinese decide they want that consumption back at that kind of growth, I mean, that's just between you and me about 22 billion pounds. I know that's not going to happen, but I guess my point is, we talk about trade to China being flat in terms of pork in 2021. It could grow just as easily as flat. And so I think there's the market that matters. I always say for the pork industry, trying to diversify that trade longer term is important. We're not going to do that in 2021. But I think finding yourself too focused on one country, which is hard not to do in this case with China, but sometimes can have some implications that you don't like from a risk management strategy.
We've been talking a lot about demand as well, but consumer demand, we touched on it a little bit. How does 2021 look as we think about COVID? We think about another round of stimulus or funding as well. How does that play into the big picture, not just for the ag economy, but the overall economy paired together? Seth, I'm going to start with you.
I think one, I got to tie it back into the ag economy because I'm not a great macroeconomist. But, you start thinking about, depending on if we all start driving again, there are implications for the ag sector as well, too, in the influence of the overall ag economy. I think we've all gotten used to working from home to some extent, and we've seen ethanol demand really take a hit because of that. How fast does it come back? Is the new normal working at home several days, or is it a return to that motor fuel consumption as the economy wraps up? I think ethanol demand is going to be a real challenge. And maybe for the long run, depending on how much of these COVID impacts have become ingrained in us and how we approach driving to work, or not taking a bus and driving to work instead. I think there's some uncertainty there, but I think ethanol demand is going to be a real challenge. So I think there are lots of things facing the ag economy that come in from the general economy, ethanol being one of those most closely related. I think it's a challenge.
Scott?
Yeah, you ask a good question. I stumble with how I want to answer. Again, I guess as I look ahead, I'm a little optimistic, but probably more in the second half of 2021 than the first half of 2021. I think we're learning it's going to take us longer to talk about a vaccination schedule that gets a majority of folks vaccinated. But I feel like when that happens and we find restaurants opening up, that we will see some demand growth. Now, I think that's a mixed bag. For some of those products that maybe grocery store demand has been stronger for them, they may lag a little bit and turn down. But some of the products, and you and I talk I'll stay in pork here. I talk all the time about bacon, right? So I go, eating out to me is a strong positive for things like belly demand as we look in 2021. So again, I view mixed bag, and only if we get a really severe drag in terms of money in the pocket am I worried about domestic demand not hanging in with us for 2021.
Josh, what about the beef side?
Yeah, I mean, everything Scott and Seth just said, spill over into the beef discussion too. It's all, Megan, about what does our macro setting look like next year, and how quickly do we get to some sort of point where we're back in a normal restaurant setting? And I think we're going to see some very similar things to what Scott just said on the pork. There's beef demand has been really strong for a lot of beef products this year, especially a lot of the grocery store. Ground beef has been incredible for much of the year. The same probably can't be said for the products that are moving through the high-end steakhouses, right? So, and those are high-value cuts. So what does 2021 look like in terms of recovery and in terms of folks getting back to normal eating out? I think all of those are the big questions that are going to have to be settled before we can really get a good picture of what's going to happen for beef demand as a whole.
As we wrap up this morning, and I appreciate everybody's time and thoughts, I want to talk a little phase one trade obligations. Seth, will go to you for this one. Where are we in terms of those targets, and how does that continue looking ahead?
Well, if you look at the letter of the agreement, it's like $36.5 billion, and that's valued at what the Chinese say when it hits China. All right. It's, we've still got everything that should count towards 2020 should have already been on a boat. If you look at the agreement, it's saying purchased and imported by China. So it has to be there by the December 31st, technically. So, but the agreement has lots of things in it about at the market that make it a little bit softer about what the actual goal is. But when we look back at that goal, we had a base year of $24 billion that it was supposed to be measured off of. And we were supposed to have about a 50% increase to $36.5 billion. We're not going to make the $36.5 billion, but we might get back to that base year of $24 billion. And that's a good trade year. That's a good trade year. So while we won't make the phase one agreement, we can't at this point, it's going to be a good trade year. Now, technically the agreement says they should import another $6 billion on top of what their old goal was next year. Again, seems like an incredibly aggressive goal that would just roil markets like you wouldn't believe, and would give us a lot to talk about. So if they start to push it, well, you can all come back on again and have that 5-hour discussion about what's going on. But let's be clear, it's been a good trade year, and any increase from this point will also be a good trade year. But those goals sitting out there in phase one would really roil markets. But we've done good. China has purchased quite a bit, and our other customers haven't backed off. Channeling Pat again, haven't backed off as much as you might imagine. And so it's going to be a good trade year, and hopefully at least as good next year.
Gentlemen, before I let you go this morning, I'm going to have you submit some final thoughts or closing comments. Josh, we'll start with you.
Sure. Well, thanks, Megan. And first, and I will say happy year end to 2020. Certainly looking forward to 2021. And I would just harp on that risk management thing. I think that is key for 2021. Cattle producers are they always face risk, right? But 2021, we're looking at some risk, not only on the output side, but on the input side as well. Check out the products USDA has. Check out futures and options. At least give everything full consideration from a risk management standpoint as we head into 2021.
Scott?
I'm looking forward to 2021, Megan, and getting beyond 2020. I like to remind us that, so COVID certainly had a lot of impacts in terms of what happened in 2020. And I like to remind us what happened in March or April of this year is we're at a much different place today, even though we haven't recovered from COVID. And to me, that helps us be more positive as we look at 2021. I don't see us in a situation where we shut down in a way that backs up HRI like it did back in March or April. And so we've built some new shock absorbers in the system that I think actually help us a lot for 2021. I'm reasonably optimistic for pork producers in 2021. I say that another $2 or $3 for an annual average hog price to me is not out of the question. I'm glad to see maybe a smaller growth in pork supplies in 2021 than we've seen the last few years. I think that all helps us. To me, the wild card with China certainly could make 2021 a really good year, to the phase one. If the Chinese decide they really want to meet that phase one deal, it's going to take more pork, I think, out of the United States to meet that. And so I think there could be some positives. At the same time, if they reduce trade with us in 2021, I think that'll be hard for the pork industry then to talk about higher prices.
And Seth, we will finish with you.
All right. Well, I'm going to take a little bit of a different tack here. As you know, this is probably my last official public action at the University of Missouri for a while. I'm taking research leave to go be chief economist at the United States Department of Agriculture, where I will do my best for the farmers and ranchers of the United States of America. So I'm going to go and learn a lot and do farm policy in DC for a while.
And we'll be glad to have you there as well. Gentlemen, thank you so much for your time this morning. We appreciate it. We appreciate your thoughts and your great comments. For those of you who are watching, check out all of the great livestock market updates that Scott and I have on Friday afternoons. You can find those all at brownfieldagnews.com. You can also check out all the great podcasts as well, which is at brownfieldagnews.com/podcast. Have a happy new year. We will see you in 2021. I'm Megan Grebner for Brownfield.